NPS, or the National Pension System, is a voluntary defined contribution pension scheme which was first introduced in 2004 and was then extended to all Indian citizens in 2009. From its very humble beginnings of just 2,200 crores, the assets under management have now risen to almost 9 lakh crores. And yes, while a lot of it is central and state government employees, people like you and me are amongst the 30 lakh subscribers that are part of the all citizen category. In fact, a recently released handbook on NPS statistics reveals that most of the voluntary subscribers last year were from the 25 to 35 age group, and that about 28% of them were women. The fact is, NPS is now mainstream, and in this video we shall examine its most important aspects in greater details. In essence, think of this video as a nice comprehensive guide about NPS, and if you find it useful, then do share it with your friends even if they are NPS subscribers. Let's begin. So first up, NPS stands for National Pension System and not National Pension Scheme. It's a common misunderstanding many people have, and if that's not enough, while the word pension shows up prominently, NPS is also not a pension distribution scheme. In fact, the true purpose of NPS is to help citizens accumulate money towards one's retirement that can then be converted into a post-retirement monthly payout, which is popularly known as pension. Having said this, NPS offers a number of benefits to its subscribers, which includes a low-cost structure, tax breaks for individuals, market-linked returns, easy portability, professional management, etc., all of which we'll discuss in later sections of this video. In terms of eligibility, any Indian in the age group of 18 to 65 can join the NPS program. This extends to NRIs, non-resident Indians as well, although the contributions made by them will be subject to regulatory requirements as prescribed by the RBI and FEMA from time to time. In terms of who is not eligible for opening an NPS account, OCIs or PIOs cannot open one. Even an HUF, the Hindu undivided family, is not eligible. An NPS account cannot be opened or operated as a joint account, and the rules don't allow for multiple NPS accounts to be operated. On the face of it, your NPS subscription would operate a lot like your mutual fund portfolio, in the sense that you'll open an NPS account, you'll decide how much to put in, equities, debt, etc. You'll make systematic contributions to your account, so basically fund it. Your portfolio grows over time. At retirement, you withdraw some of your money and also set up an annuity, and this annuity gives you monthly income in your retirement years. In fact, the checks and balances put forth by the Pension Fund Regulatory and Development Authority, the PFRDA, in the form of having an NPS trust, a CRA or Central Record Keeping Agency, a custodian, etc., is very similar to how the Indian mutual fund industry works with a sponsor, trustees, custodian, and a transfer agent. Now, there are two types of NPS accounts here. Tier 1 and Tier 2, which frankly sounds like I'm traveling by train in an air-conditioned bogie. So a Tier 1 account is mandatory for everyone who opts for NPS and is also referred to as the pension account. A Tier 2 account is entirely optional, and it's like a voluntary savings facility, which is why it is commonly referred to as the investment account. Now, there are a number of differences between the Tier 1 and Tier 2 accounts, but prominently there is the taxation bit, where the Tier 1 account gets a host of benefits while the Tier 2 taxation benefits are restricted to government employees. Similarly, on the flip side, Tier 2 accounts offer greater flexibility, and one can withdraw their money from the Tier 2 account at any point of time. As a matter of fact, NPS allows its subscribers to select different investment patterns in either of these accounts. So if you want to have a debt-focused Tier 1 account and an equity-focused Tier 2 account, then this is very much possible. Okay, now that I've mentioned debt and equity with regards to asset classes, NPS offers a total of 4 options. Firstly, there is Class E, where E stands for equity, and the money here gets invested in the stock markets. Then there is Class G, which is government securities, and this includes bonds, T-bills, and different securities that are issued by the central or state government. The third asset class is Class C, where C stands for corporate debt, and investments from here go towards the purchase of bonds issued by PSUs, public financial institutions, infrastructure companies, and also money market instruments. And finally, we have asset class A, which includes alternative investment funds like commercial mortgage-backed securities, real estate investment trust, InvITs, etc. I think the PFRDA has these asset classes to cater to different risk return profiles with equities and government securities at either ends of the pool. More importantly, it's this combination of these four assets, that is E, G, C and A, which has the largest bearing on how much your NPS corpus grows to by the time you reach your retirement age. Okay, now that we know the asset classes, the next decision a subscriber needs to take is on how and how much to allocate. In this context, NPS offers two options. That is, a subscriber can go for auto choice or else one can opt for active choice. Now, as the name suggests, the auto choice option is designed for investors who don't want to take asset allocation decisions. This structure then works like any passive instrument, and your funds are allocated on a methodology-driven life cycle-based approach, which starts with an equity-heavy portfolio when the subscriber is young, and it then systematically gets rebalanced and the equity exposure is reduced as the subscriber approaches retirement. But having said this, the investor does have to make one decision, that is the type of life cycle fund that he or she wants to invest in. You see, NPS offers three options here. An aggressive life cycle fund where the maximum equity allocation can go up to 75%, a moderate life cycle fund where equities are capped at 50%, and a conservative option where equities are limited to 25%. Now notice I used the word up to 75%, and that's because the portfolio allocation is done on an age-based table that the PFRDA follows. For example, if you are 35 years old or younger, then your active choice aggressive life cycle portfolio will have 75% in equities, 10% in corporate debt, and the balance 15% in government securities. As you get older, this fund will automatically optimize your portfolio by reducing the percentage in equities as it simultaneously increases the proportion of government bonds. Similarly, in a moderate life cycle fund, the equity component is 50% up to the age of 35. It tapers down gradually to 40% by the age of 40, 30% by 45, 20% when you are 50, and finally closes at 10% by the time the subscriber is 55 years old. A comparable sequence is seen with the conservative life cycle fund as well, and all of this is automated with the rebalancing between asset classes happening once a year on the date of birth of the subscriber. The second option, that is the active choice option, is available for NPS subscribers who want to design their own portfolio and decide their own asset allocation. The NPS rules allows a lot more freedom here, but it does come with some conditions. For instance, the maximum permissible allocation to equities is 75% and not 100%. Similarly, alternative investment funds, that is Class A, is capped at 5%, and this option is available only to Tier 1 NPS investors. In fact, until last year, there was also an age-based condition that required the subscriber upon crossing the age of 50 to start lowering their equity allocation every year by 2.5%. However, this requirement has been done away with, and NPS investors can keep 75% in equities until the age of 60 now. In my opinion, the decision between auto choice and active choice is not a tough one. And if you have a broad understanding of asset allocation and rebalancing, then an active choice should be considered, and if not, then you can settle for the auto choice option. In fact, the PFRDA also allows movement within choices, and one can move from auto to active and from active to auto once in a financial year. As explained earlier, there are 4 asset classes that are offered under the NPS program. Now, I've looked at data over different time periods, and on an average, Class E, that is equities, have averaged around 13% over a 10-year period. Government securities and corporate bonds have returned a little over 8%, and while the option of an alternative investment scheme was not available 10 years back, over the last 5 years, Class A schemes have clocked about 6% returns. When I look at these numbers as a portfolio, even if it's auto choice, it would be fair to assume that NPS has delivered in the range of 10, maybe 11%. Another observation here is that unlike mutual funds, the performance of pension funds within every category has been pretty similar to one another. In fact, the fund's performance has been very similar to the benchmark as well, which probably means that most participating pension fund managers are playing it safe and are merely trying to mirror the index. I mean, on a periodical basis, the Class E and the Class C funds have been very close to their benchmark returns. The only exception here are the GSEC funds. And what seems to have happened here is that while a gilt fund generally has an average maturity of 8 to 11 years, the Class G NPS schemes seem to have a much higher maturity of 14 to 17 years, which makes comparison a lot more difficult. But then it doesn't mean we can't compare these funds, and when I did that, LIC seems to have a good hold on this category, with the more recent successes going to Aditya Birla. When it comes to corporate bonds, the average NPS fund has delivered returns that are a little higher to what the S&P BSE Corporate Bond Index has offered. One explanation for this overperformance is the fact that NPS Class C funds are allowed to invest in corporate debt instruments like rupee bonds, listed debt issued by banks, corporates, tier 1 bonds, etc., as long as the rating is AA and above, and the funds can also invest up to 10% of their portfolio in a lower rated A paper, which obviously helps in delivering a better performance as the credit risk in the NPS portfolio might be slightly higher. On an yearly comparison basis, the Scheme C funds of HDFC and ICICI Prudential seem to have shown reasonable performance and consistency over the years. And finally, when it comes to equities, what absolutely stands out is that most NPS funds in this category have a very heavy large cap bias, with almost everyone having at least 90% of its holdings in large cap stocks. On a comparison basis, HDFC and Kotak Mahindra have been the more consistent and better performers in this pack. But having said this, I have to mention that the NPS Class C funds have generally underperformed the Nifty 50, although it's not by much. So to put this together, NPS returns are not fixed, which means there is no interest rate like what one receives in an FD or Provident Fund account, and instead the returns, much like a mutual fund, are market linked, and it depends on how the pension fund manager has performed. If you're getting good value from this video, then please do give this video a thumbs up. And if you aren't a subscriber yet, then do consider becoming one, as I can then serve you videos as soon as they are released, and also share with you some investing strategies, tips and stories that I continually post in the community section. So to manage our NPS assets, presently there are a total of 10 pension fund managers. This includes the biggies like SBI, HDFC, ICICI, Axis, etc., the usual suspects, and also a couple of life insurance promoted pension managers, that is the LIC Pension Fund and Max Life, which was given a license by the PFRDA just last year. Now, while the NPS rules allow subscribers to have different pension managers for their tier 1 and tier 2 accounts, the rules do not allow a subscriber to choose different fund managers for different schemes within the same tier. In other words, you cannot choose HDFC pension fund for government securities, then a Kotak for equities, and then separately appoint an LIC for corporate debt. In other words, the NPS subscriber can select only one pension fund manager to manage all 4 assets, and this can be a slight headache because over the last 1 year, Kotak has delivered the best returns in equity, LIC was P1 in corporate bonds, while UTI did a wonderful job with government securities. Now, in this context, the selection of a fund manager is not really a specific asset class exercise, but it requires us to look at how the pension fund manager has been performing on a portfolio basis. In this case, your allocation matters. And let's say I am on an active choice with 60% in equities, 10% in corporate bonds, and 30% in government securities. Now, when I apply these weights on the entire data, then probably a better and more realistic selection methodology appears. But as I said earlier, all NPS schemes seem to be delivering a similar sort of returns, whether I look at them individually or as a portfolio. However, everyone has to choose a pension fund manager, and at any time in the future, if you feel compelled to change your fund manager, then the NPS rules do allow you to do that once in a financial year. An NPS account can be opened in the physical or in the online mode. To open an NPS account offline or manually, one needs to find a POP, a point of presence as the PFRDA calls it, which can also be your closest bank branch or post office. Then submit an account opening form, furnish your KYC documents, so a copy of your identity proof and residence, a passport size photograph, your bank and nomination details, and you are good to go. The online process is even faster, and it is now possible to open an NPS account in less than 30 minutes. You just need your PAN, Aadhaar, mobile number, net banking account, and one can use enps.nsdl.com or any of the dozen websites and apps that offer NPS account opening options. So online or offline, once the applicant makes his or her initial investment, the system would generate a 12-digit PRAN, a permanent retirement account number, which will now allow the subscriber to operate his or her NPS account from anywhere, even if there is a change in city or employment. In fact, the PRAN makes your NPS account super portable, and one can even shift from one sector to another, that is from central government to corporate sector, from the state government to central government, etc. Also remember, an initial minimum contribution needs to be made when opening an account, and for a tier 1 account this number is 500 rupees, while a tier 2 account requires a minimum contribution of 1000 rupees. Can I operate my NPS account online? It seems a very outdated question in this day and age when we are so used to online banking and mobile applications. But to answer the question, yes, certain services related to NPS can be availed online via the NSDL website or their mobile app. These services include any change in address, and this can be done with Aadhaar-based authentication. You can change the scheme preferences, modifications in mobile number and email is possible. You can contribute online, subscribers can view their statement of holding, they can get a list of transactions, one can print the PRAN card, a grievance can be registered online, etc. In fact, the eNPS also allows updation in nominee details, and NPS members can add up to 3 nominees. In terms of who can be a nominee, a subscriber can add one's spouse, children, dependent parents, etc., and can also decide on the accumulated pension funds distribution percentage amongst nominees. Another query related to the maintenance of an NPS account is around the minimum contribution. So for the tier 1 account, a subscriber is expected to invest at least 6,000 rupees a year. However, if you were to skip paying this money, or if you pay less than 6,000 rupees, then your NPS account will be frozen and you won't be able to transact until you've paid the minimum contribution along with a penalty of 100 rupees per year of no contribution. Now, once the age of 60 is reached, every NPS subscriber has 3 options to choose from. The first is to continue NPS with contribution until the age of 75, that is, the subscriber keeps investing and adding to his or her NPS corpus. The second option is to continue NPS until 75 but without making any further contributions. And option number 3 is to exit NPS at the age of 60 itself, in which case the subscriber can withdraw 60% of the corpus as lump sum, while the remaining 40% is used to purchase an annuity. We'll discuss annuities in the next section, but overall upon retirement, these are the 3 options available, and in case the subscriber has not initiated an exit or deferment request, then it shall be assumed that the subscriber wishes to continue NPS until the age of 75. So this is something for you to watch out for, but pleasantly the NPS rules do allow a subscriber to exit NPS anytime during this continuation period. Now, a common query here is around withdrawing money before the age of 60, and subscribers do have some options here. So scenario 1 is where the subscriber wants to exit the scheme before attaining 60 years of age, and per the current rules, one can withdraw 20% of the corpus as lump sum, while the remaining 80% has to be applied towards the purchase of an annuity from where the person would receive regular payouts. But having said this, there is a provision in the rule book that says that if your total corpus is less than 2.5 lakh rupees, then the subscriber can prematurely withdraw the entire corpus and none of that money needs to go into an annuity. But let's say you want to do a partial withdrawal, in which case the PFRDA does allow it. However, it comes with some conditions, like a premature withdrawal can be done only after 3 years of regular contribution. One cannot withdraw more than 25% of your own contribution. The withdrawals can be done only 3 times during the entire tenure. And finally, the reasons for which one can withdraw are limited to situations like a medical emergency, a child's higher education, the child's marriage, or the construction and purchase of a house. Now, the good thing is all these partial withdrawals are tax free, but remember, I am only talking about tier 1 NPS accounts here. When it comes to tier 2 withdrawals, while there are no such limits and conditions that we saw with the tier 1 part, I must say there is a lot of ambiguity on how capital gains on tier 2 withdrawals should be taxed, and I've read articles where different tax experts and chartered accountants seem to be saying different things. Simply said, an annuity is a financial instrument, and the way it works is that one would purchase an annuity by paying a lump sum amount of say 1 crore, and the insurance company would provide the annuity purchaser and their family a fixed monthly income for a specified period of time. This monthly amount depends on a number of factors like the type of annuity chosen, the tenure, the annuity provider, etc. But importantly, once an annuity is purchased, it becomes a contract, which means the rate of return gets locked and does not change during your pension receiving period. So there is a lot of predictability in this product, which is why it is loved by a majority of senior citizens, especially in developed countries. Annuities in India are commonly known as pension, and the NPS rules require that at least 40% of the corpus is used to buy an annuity from an annuity service provider, which is nothing but a life insurance company. Now, annuities itself come in many forms, and I'll share some of the more popular ones here. But if you want to know more, then do connect with a life insurance company who can offer you a more updated product portfolio. So the most basic one is called life annuity, and very simply you will receive a fixed payment every month as long as you are alive. An example of that would be to say you are 60 years old and you buy a life annuity worth 1 crore, and per the terms of the contract, the life insurance company needs to pay you 50,000 rupees every month until the day you die. Another variation of this is the joint life last survivor annuity, which would not only pay you a pension until your death, but even post that your spouse would continue to receive that same monthly annuity until he or she dies. Of course, since there are two lives involved, instead of receiving 50,000 rupees a month, you will be contracted a lower monthly amount of say 40,000 rupees. And then there is an even more popular variant where you receive some annuity, and after you die, your spouse continues to receive that monthly payout, and after your spouse also dies, your nominee gets the original corpus amount. So in our example here, understandably, the 40,000 will go down even further to say 35,000 rupees. And once the annuity buyer and the spouse expires, the nominee will receive the original amount of 1 crore rupees. So there are a number of annuity options at our disposal, and as the pension industry develops, we'll see a lot more innovation on this front. To call an NPS a triple E instrument is a matter of perspective. So technically, triple E or exempt has three parts to it. The first exempt means that the contribution qualifies for exemption from taxes, which is definitely the case for NPS. The second exempt is on the returns earned, which applies to NPS as there is no capital gain or wealth tax to be paid. And the third exempt is on the withdrawal of money, and in my opinion, no taxes are applicable, although some people might not agree to it. We'll discuss this part in slightly more detail, but let's start with the tax exemption bit. Now, employees receive a host of tax deductions, and they are generally eligible for a deduction of up to 10% of one's basic plus DNS allowance under Section 80 CCD1, subject to a maximum of 1,50,000 rupees. There is also a tax deduction of up to 50,000 rupees under Section 80 CCD1B, which is over and above the 1.5 lakh limit. And thirdly, if the NPS contribution is coming from the employer, then the employee is eligible for a tax deduction of up to 10% of salary, that is basic plus DA, which goes up to 14% if this contribution is made by the central government. In fact, on this third point, the employer also gets a tax break, and companies are allowed to book the contribution made into the employee's NPS account as a business cost in its profit and loss statement. Now, if you've been keeping track of my videos on what I understand and what I don't understand, then you would know by now that taxation is not my strong suit, and therefore I will strongly urge you to consult a tax advisor for better clarity on this subject. Okay, now let's turn our attention to the controversial third exempt from our triple E list, that is the tax treatment when withdrawing money. Now, there are a number of scenarios here. Firstly, when one makes a partial withdrawal, then as per Budget 2017, amounts withdrawn up to 25% of the subscriber's contribution is exempt from taxes, and we've already discussed this part. Secondly, if the subscriber dies before maturity, then the entire corpus which is withdrawn by the nominee, well, that entire amount will be treated as tax-free and the beneficiary does not need to pay anything on it. A third scenario is where the subscriber exits before attaining the age of 60, and in that case 20% of the corpus received in lump sum would be tax-free and the balance 80% which is received as an annuity based payout would actually be taxable as per the current income tax rules. And probably the most common scenario is at the time of retirement, when the subscriber can withdraw up to 60% of the corpus as lump sum wherein no taxes are applicable, and then the remaining 40% that goes towards the purchase of annuity, well, the subsequent pensions that are received are taxable as per the investor's income tax slab. And although we get a little panicked when we think of taxes, one should also take into account where your tax slab will be when you are 65, 70 years old. If you are retired and you don't have an active income, then it's probable that your tax slab will be maybe 10% or even 0%, and those realities should be taken into account when you are thinking through the entire process. Right, so we have covered a number of areas in this video, and to put it together, there are two parts to any retirement plan. The first is the accumulation part, and NPS requires you to contribute consistently and to also decide on the asset allocation which has a sizable bearing on the final corpus. And secondly, there is the post-retirement part where you need to narrow down on the right annuity plan and the right annuity provider so as to receive monthly income. Both these parts are neither too easy nor too difficult, but I sincerely hope this video has broadly given you an adequate idea on what to expect and to not expect from the national pension system. I would encourage you to also go through some of the additional resources I've attached to this video's description, and if you have any questions, then do post them in the comment section below. Once again, thank you for your time. Do share this video with others. Do subscribe to my channel, and I'll see you 3 days from now. Until then.